Hi, Sharon here. If you've ever received a crypto tax report from software or even from a tax professional, here's a question for you. Did you actually look at it before you filed your tax return? Most people don't. They assume that if the report looks professional, it must be correct. I understand why. But after reviewing over 1,000 crypto tax engagements over the past 8 years, I've learned that's not always the case. One of the first things I look for is assets being sold with zero cost basis. I once reviewed a report showing more than $100,000 of stablecoin sales with zero basis. That immediately caught my attention because stablecoins like USDC are designed to maintain a fairly stable value. The client hadn't made a $100,000 profit. The acquisition history was missing. Zero basis doesn't always mean there's an error, but it's definitely something to investigate. Another thing I compare is the ending balances. If your report says you own 3/4 of a Bitcoin, but your wallet shows 1 Bitcoin, something deserves a closer look. That difference may point to missing transactions, duplicate imports, or transfers that weren't matched correctly. Before I trust the gain or loss calculation, I want to understand why the balances don't agree. I also pay close attention to transfers between wallets. Moving crypto between wallets you own is generally not taxable. But if one side of the transfer is missing, the software may treat it as a sale or as taxable income. I see this more often than many investors realize, especially when assets move across several exchanges or wallets. Another situation that deserves extra attention is when you've changed exchanges, wallets, or crypto tax software over the years. Many investors think they only need this year's transactions. But if you sell crypto you bought several years ago, the software still needs the original purchase history. When part of that history is missing, your cost basis may be wrong without you realizing it. Sometimes a report includes tokens the investor doesn't even recognize. It could be a scam token, a wrap token, or 2 different assets that share the same ticker symbol. When you see something unfamiliar, don't assume the software knows something you don't. Ask why it's there. If you actively use DeFi, staking, lending, or bridging, spend a little more time reviewing your report. These transactions are harder to interpret than a simple buy or sell. A loan can look like income, a bridge can look like a taxable sale, and several blockchain transactions may really represent one economic event. The more complex your activity is, the more important it becomes to verify how it was interpreted, not just whether it was imported. Finally, and I think this may be the biggest warning sign of all, you've never actually reviewed your crypto tax report. Most people assume the software or their tax professional already checked everything. But you still know your own activity better than anyone else. You know whether you bought that token. You know whether a large transfer was simply moving funds between your own wallets. Even a short review can help identify issues before the return is filed. The goal isn't to make you second-guess every number in your report. It's simply to know what deserves a closer look and to ask questions before you file. A report that looks finished isn't necessarily a report that has been fully verified. Thanks for watching.